Well, hey everyone, welcome back to my channel. I'm Brian Stites with RE/MAX Results and the Twin Cities Real Estate Guide. And today we have a special guest in the studio, and we're going to be talking about FHA and conventional loan types and the ingredients for a loan. So we're going to get started right now.
Hi, my name is Jeff Pappenfus. I'm a licensed mortgage loan originator with Mortgages Unlimited. My NMLS ID number is 230856. And I'm here today to talk with you about the difference between an FHA and conventional mortgage loan. And really what that leads into is a discussion about what determines what type of a loan someone would get qualified for. So what determines which direction you're going to go with your mortgage loan approval is really determined by the ingredients of a mortgage loan approval and determining what is the level of risk associated with lending money to someone that wants to purchase a home. So if you were to picture someone giving you $250,000 to purchase a home, all that investor is trying to determine is what is the likelihood that you'll pay that money back to them in a timely manner on a monthly basis. And there's four key components that are going to help determine the level of risk associated with you and determine what that likelihood is. Those four key components, or the ingredients of a mortgage loan approval, are your credit score, your debt to income ratios, the loan to value, and your cash reserves.
Click the card above for a full video on credit score.
Another one is, the second thing is your debt to income ratios. Now, ideally speaking, an investor doesn't want you to exceed a certain percentage of your gross monthly income for both your housing expense and all of your monthly debt obligations. Ideally speaking, you want to stay between 31 and 33% of your total gross monthly qualifying income. You don't want to exceed that for your total principal, interest, real estate taxes, homeowners insurance, and mortgage insurance. And in some cases, if you're buying a condominium or a townhome, your monthly association fee. So if you take your total housing expense and divide that by the total gross monthly income, you don't want that to exceed generally more than 31 to 33%. Once you add on all of your other monthly payment debt, those for revolving accounts, department store accounts, student loans, automobile loans, anything else that would show up on your credit report, someone who is reporting that account to Experian, TransUnion, or Equifax, one of the three repositories on a tri-merge mortgage credit report, all of those minimum monthly payments plus the proposed housing expense divided by your total gross monthly income is how we determine your back debt to income ratio. Generally speaking, investors don't want that to exceed more than 41 to 45%. The third thing is loan to value. What percentage of the home's purchase price or appraised value, whichever is less, are you financing? So as far as loan to value goes, your loan to value is always going to be calculated off of the lesser of the two things, being the appraised value or the purchase price. If you're putting 10% down, then your loan to value will be 90%. If you put 20% down, your loan to value is going to be 80%. So it's just the percentage of the home's purchase price or appraised value that you're financing. And simply put, the higher the loan to value, the more risk you are to the investor. Somebody who only puts 5% down is less of a risk than somebody who puts $100,000 down. So one way that you can compensate for a lower credit score is by putting more money down. With an FHA loan, your minimum down payment is 3.5%, so the loan to value would be 96.5%. There's conventional loans that have 97, 95, 90, 85, 80% loan to value. A little more options there. And then finally, the last item would be your cash reserves. How much money do you have left over after you purchase the property? Sometimes a client will choose not to put 20% down or put a lot of money down because they want to keep an investment intact, or they're going to utilize those funds for something else completely different. Now, in a situation like that, the investor will be fine with that if they can see that you've got 24 to 48 months of the proposed housing expense in a reserve account over here. We call that a compensating factor. So if your monthly payment for principal, interest, taxes, and insurance is $2,000, and you have $48,000 sitting over here, or 24 months worth of your mortgage payment, they're going to feel more comfortable with approving a loan like that. So credit, debt to income ratios, loan to value, and cash reserves. Those are the 4 key components that they look at to determine the level of risk associated with you.
Well, hey gang, thanks for sticking around. Hopefully you enjoyed the content. We put out some great information each and every week. Check out the next video right over there for some more great information. If you've enjoyed the channel, love for you guys to subscribe down below and hit the little bell to get notifications. We put out videos each and every week. Thanks very much. Talk to you later. All right, take 5. We'll put this in the blooper. Debt to income. So Jeff, can you tell me a little bit about Jeff, I don't know. I'm fine when I'm by myself. I get people in front of me.